There's a new twist for first home buyers struggling with interest rates rising. Some prospective home buyers with pre-approvals are actually being caught out with interest rates rising after learning their borrowing capacity might have actually changed. This is because pre-approvals aren't actually valid for all that long. They go out of date quickly, and even if they are valid, a lot of banks try and reassess your position based on the changes that have been happening. Now, for many people, their borrowing actually differs from where they might have originally thought they landed, and getting a pre-approval is still a very important part of the home housing hunt, but it's important to be across these details, especially with 5 rate rises and what that might actually mean for you. So let's have a look at APRA's serviceability ratio and why that affects pre-approvals, as well as the latest in borrowing capacity with all these rate changes. So we can see here, APRA had previously come out to the market and said that they're increasing the serviceability buffers that the banks use to at least 3% of October in 2021. What this effectively means is when the banks run an assessment on your borrowing ability, they're looking at the rate that you're getting, say it's 4%, plus a buffer of 3%. So they're saying, can you afford your mortgage repayments if the rate went to 7%? Now, this buffer previously was only 2.5%. In October of 2021, the regulator came out and said to the banks they had to change that, they had to increase that buffer. So what this means for borrowers is they're being assessed on a higher rate, which reduces your borrowing capacity. If we take a look at what actually happened in the last 5 months, we can see the cash rate the Reserve Bank has increased by over 2.25%, and this has a direct effect on borrowing capacity. Now, a number of lenders, or all lenders, do pre-approvals. Not all pre-approvals are the same. So some banks actually will give you a fully assessed pre-approval. They'll check your pay slips, they'll look at your bank statements, and that pre-approval will be valid anywhere from 3 to 6 months. Now, the problem with this is, whilst we've had 5 consecutive rate hikes, if the bank's done an assessment, say in April or June this year, they might actually say you're pre-approved for a certain amount, but when you go to purchase and go ahead with the purchase, they will put the new APRA regulatory requirements and that buffer of 3% we talked about on the new rates. So the new updated variable rates that you're getting from the bank with the increased cash rate. That effectively reduces your borrowing power. Let's take a look and see what that actually means. So let's say you're on $100,000, you're a single person, and previously to the change, the official assessment rate was about 5.25%. What that meant for you is that you could borrow $588,000. Now, we've seen a number of changes in the marketplace, mainly around the cash rate. So let's say your income hasn't changed, your liabilities haven't changed. What is that actually going to mean from a borrowing point of view? The assessment rate has now increased. Let's say you can get a 4.2% interest rate from bank A, B, or C. We add a 3% buffer on that, which means the assessment rate is now 7.2%. That means your official borrowing power has reduced. It's reduced by nearly 20% from $588,000 to $479,000. Now, this is a real issue because if you are pre-approved, there are a number of lenders which will actually try and reassess your position based on today, not when you did your pre-approval 5 months ago, even though their pre-approval lasts for 6 months. It is still very important to get a pre-approval, especially if you're a first homeowner. You want to understand your assessment, where you sort of stand from a deposit point of view and your borrowing power point of view. Now, we did talk about the borrowing power is something that's going to keep changing. There are some lenders that will lock in your assessment at pre-approval stage. So it's important to work with a mortgage broker like ourselves where we can assess your situation and give you an idea on what lenders are doing what. And if you are going with a lender where they're going to continually update your assessment, we can talk about how each rate rise will impact your maximum borrowing ability. So getting a pre-approval is still a very, very important step. Understanding that borrowing assessments change also means that if you are thinking of going to an auction, you want to make sure you re-talk to your broker, and if you did your pre-approval a month or 2 months ago, that you get that reassessed and you make sure that there's not going to be any nasty surprises, given that we've seen so many rate rises and borrowing power reducing as a result. So talk to your broker, go back, reassess your situation, and revisit from where you initially left off to see if that's still where you can land or if it's somewhat decreased given that all these changes have happened. Now, it also is important to understand, working with a broker like ourselves, we have a range of lenders. So if you've previously been pre-approved for a certain amount and then you can't hit that amount anymore, we've got a number of different lenders that will give you a different outcome. As we can see here in the above example, for a customer with the exact situation, circumstances, income, each lender has a different outcome. So we can see on the top end, the maximum borrowing power is 1.2 million. On the bottom end, you're only getting in around the 900,000. So that could be a big difference between being able to actually achieve where you want to land and not. And we can see the assessment rate the banks use vastly changes, which gives a vastly different maximum borrowing capability. So something to keep in mind, especially when you are wanting to understand where you can land from a borrowing perspective. If you've dealt with your bank directly and they're not giving you the outcome that you're after, that's where getting in touch with a mortgage broker is certainly something that can help. We know with a lot of consumers at the moment, the property market is certainly softening up. It's becoming more of a buyer's market, and you don't want to be putting any more undue stress on your situation and not being able to understand that your capacity is going to be able to reach where you want to get to. That's where potentially putting in offers with a finance or cooling off period will protect you in the event that your assessment has changed and the bank can't give you the funds that you initially thought you could get. Putting in a 14-day finance clause, for an example, will allow you to have time to go back, get the bank to reassess, value the property, and then say yes or no, whether or not you can get your finances to work. And once again, it's recommended that you talk to your broker before you make any offers to make sure that if there has been any changes to that assessment, you fully understand where your new capacity lands. It is important to recognize that pre-approval isn't an absolute commitment from the bank, and there are still a number of reasons why you can get declined. On our website, we've got 27 reasons why you might get declined after being pre-approved. So check that out. It's important to be aware of what might actually happen. And here at Hunter Galloway, we're mortgage brokers. We're based in Brisbane. We deal with people Australia-wide. So if you're needing assistance with finance, hit us up. Hit that get a free assessment button on our website where you put in your details. Super simple. We'll give you a buzz and see what we can do, or call us directly on 1300 088 065, and we'll see you next time.